we have to take care is about the accounting. And over the period, the importance of accounting standard has been given very less because the scrutiny doesn't happen so frequently. Sometimes the profession, quality, timeliness, everything is being dragged or taken care based on the response of the department, based on the response of the regulatory. If the regulation doesn't take much emphasis, if they don't identify some mistakes, then obviously the importance to the quality has been even less. Due to this also, and in many cases, some financials are being coming at the last moment, and we have less time to look at the compliance of accounting standards. So, very simple process which is being done by many chartered accountants is that to look at the previous year, carry forward, copy or save this to current year, and then carry out the work which is required. However, this may lead to have certain errors which may be there, may not be considered during the current year which is required. In addition to the erroneous or mistake part which can happen with the copy pasting, there are also few very important things which we need to take care about the accounting standards. In ICAI, there is a Financial Reporting Review Board, FRRB. This FRRB of ICAI was set up in 2002. The primary objective of FRRB was to really give and review the financial statements, selected financial statements, and then look at the non-compliances. And these non-compliances are generally addressed to the auditors so that they can take care of the non-compliances in the next period. And in case certain non-compliances which are of very, very high nature, where the non-compliance level is very high, it affects the investor stakeholders in material aspects, and these are also being recommended to regulatory for taking actions. Now, the role of Financial Reporting Review Board has been there to look at and ensure that the quality of the financial reporting is intact. Ultimately, the quality should be intact is the requirement of each and every practicing CA. Now, when I refer to here is about this particular topic is common errors in financial statements relating to accounting standards. So, what we are going to talk about? We are going to talk about the few very, very important accounting standards related issues which are commonly find out, and these have been taken from the compendium of FRRB, which has been published by ICAI. So ICAI FRRB published on regular basis the compendium of all the financial reporting issues which have been identified, and from the compendium is the accounting supervise the list compilation of all the issues have been there. So I recommend all of you to, in case you want to get the more information, more detail, you can refer to the compendium of ICAI which is published. It is available on ICAI resource page. Now, when I talk about these particular things, let us look at the next slide. Warren Buffett has mentioned that it's good to learn from your mistakes. It's better to learn from other people's mistakes. I think that is what is the main purpose, core purpose of conducting this particular session. Instead of waiting for us to do mistake, let us look at what the mistake. Let us look at what the errors have been already found out by FRRB's review, and from that error, let us understand how can we really ensure that these kind of errors doesn't happen in our own firm. And in my humble request to all of you that this is the era where we cannot ignore compliance with accounting standards. Registrar of Companies, Ministry of Corporate Affairs have employed many chartered accountants only for the purpose of the critical review of financial statements. Government also wants to ensure the quality of the reporting has to be intact. We already have noticed that since couple of years back, there has been a lot of review investigations happening. In case of Ireland FS case, there is a case where SFIO has also prohibited an auditor for a certain number of years with the fine and penalties. Now, this is going to be a routine case over the period where the government regulatory wants to ensure that once you certified, that certificate carries a huge impression, which has also been noticed and which has also been told by our Prime Minister of India, Shri Narendra Modi, saying that the signature of CA carries more value than the signature of Prime Minister. That is the most important importance. That is the what the importance to the CA has been given by Prime Minister itself. Now, when we sign any financial statement and when we give an audit report, and in the audit report itself, we are mentioning that it has been complied. The accounting standard, laws and regulations have been complied with. That is what a certification which is given by auditor when they sign it. Now, when we say that it is complied with this sign, that means it carries the lot of importance, a lot of value. So it is a duty, primary duty on all of us to ensure that the accounting standards are complied with. If you look at the all laws regulations, and where the most important thing as a standard accountant is critical is the accounting standards. If you have a GST can also be handled by the indirect tax professional, VAT professionals, by the tax professionals. Income tax can also be handled by tax professionals. It's only the audit or accounting standards that is the only domain of a chartered accountant. If I talk about anybody asking you a question about what is the specified domain of chartered accountant, is only accounting standards. And when we sign any financial statements with saying that its compliance with accounting standard is right and correct, we cannot ignore the quality of compliance. We cannot ignore the requirements of each accounting standards. And the purpose of this particular session is to really give you and bring about the commonly found errors when the FRB has reviewed the financial statement, which are the commonly errors are find out, and this listing I have done. Obviously, the attempt has been there to not look at the all kind of errors, because the listing and errors is huge. You can definitely refer to compendium. However, what we have done is that the few accounting standards have been selected, and out of the few AAS, the certain very common errors which are common disclosure requirements are there, they will identify. Now, when we refer to this particular common errors, basically it means that these are visible from the financial statement itself. Now, there may be some more errors which are part of the accounting compliance, like measurement requirements or accounting. Now, the measurement accounting may not be visible directly from the annual report. These errors will be identified based on the review of published financial statements, which is already available either in the filing with MCA or is already available on the SEBI, NSE, BSE websites. So the errors which have been identified right now, they are the primarily based on review of the finalized published financial statements without interaction with the auditors, without getting the information details from the management. So these are mainly relevant with respect to the disclosure requirement. That is the requirement of accounting standards. Now, these particular things are required. Why? Because whenever the financial statements annual report is filed, at that time the regulators and other investors, other stakeholders, they are going to get information based on what is written there. Now, something which is written there, which is not in compliance with accounting standards, it is a duty of the auditor to brought out or to provide qualification is required. So the attempt here is made to ensure that let us look at which are the mistakes commonly done in compliance with accounting standards. And my humble request to each one of you that please ensure that the system in your office has to be improved. We need to train first ourselves, and then we need to train the staff CA article who handles this job in our office. And then we have to ensure that the system has been developed in such a fashion wherein that these particular activities has been captured properly. So now this particular statement of Warren Buffett, which is hold to you for each one of you. So I compliment to all of you that you were chosen, you were selected to attend this particular session because you want to learn from other mistakes, not learning from your mistake itself. So let us look at which are the other commonly errors find out here. So what I've done, I have divided the accounting standards into the three parts. Part A, primarily from AS1 to AS10. Part B is from 11 to 20, and Part C is from 21 to 30. Again, I'm putting the point that I'm not going to discuss on all accounts, all issues, but these are the primarily which has been commonly identified, commonly found in various financial statements. That's what we are going to look after. Now let us look at first is on AS 1 to 10. At any point of time, if you have any questions, you can definitely basically put in the chat box, or we can also discuss. And I would also require to have your interaction within this period, because the time period is 3 hours, and within 3 years period, it is utmost important for us, all of us, to have interactions. Otherwise, the session will become more dull. And this is a very practical session which I would like to have your inputs, your interaction also when I talk about these particular requirements. Now, let us look at AS2 inventories. Now, these are the few annual report when we look at the accounting policies regarding valuation of inventories as disclosed in the annual report of several companies are listed below. 1. Stocks of cards are valued at cost and on FIFO basis and include all applicable overheads in bringing the inventories to their present location conditions. Work in progress is valued at cost. This is the reporting which is done by one of the company. Another company has done reporting that work in progress is valued at direct raw material cost and appropriate cost of completed process. Third, raw materials are valued at average cost. Raw materials at bonded warehouse stores, spares, consumables, packing material, coal, and fuel are valued at cost. See, I am going to ask you questions, and you are supposed to give response in a chat box saying which errors or what is the non-compliance you notice in this particular accounting policy. So just look at these particular accounting policy disclosures, and then please identify the non-compliances which has been done here. Work in progress is valued at raw material cost. Cost of finished goods and work in progress are determined on estimated cost basis. Now, this is what the disclosure which is done here. I request all of you to please participate in this particular thing and identify what is the kind of non-compliance which you notice here, and please write down in the chat box. Anurag ji says WP do not have overheads. Okay, fine. Any other? I want all of you to be participate, because I understand the membership number is very important for you to look at your CP point of view. But however, let us look at understand. Arpit Mehta ji, it should be cost or NRV which is lower. Okay, very good, Arpit. Cost, yeah, Anurag ji, come again. Cost and NRV which is lower. Very good. Anybody wants to respond? Sanjay, cost is production cost. Fine. Any other? So if you look at this, okay, fine. Tejas Gandhi, finished goods and WIP cannot be valued at estimated cost. Fantastic. Cost or energy is lower. Very good. Any other? Anurag, yes, Anurag, you are there. Raw material should be valued at cost. Okay, fine, Anurag. Everything should be valued at either cost or energy which is lower. Any other views? Okay, let us look at what the standard talks about. First, the paragraph 3.2, 5, and 6 of AS2, these are very critical. It mentions the fact that basically the inventory is to be measured at lower of cost and net reserve value, right? So it is about inventories. Now, if the perception is thereof is such that the raw material or some WIP may not be required to be at NRV, I think that is the wrong notion. Either it's raw material, WIP, finished goods, stores, spares, any inventories. All inventories should be measured at cost or NRV which is lower. So in all these cases, one line of thing which was very critical, which was missing here, was that the measurement of inventory should be at cost or NRV which is lower. Yes, Potharaji, yes, you're right. Every inventory should be at cost or NRV which is lower, right? Second very important thing is that the cost of inventory should comprise what? So here when you look at the para 5 and 6 talks about what the cost of inventory should imprise. Inventory cost should include one, which is the cost of purchase, cost of conversion, and their cost. Now when you look at these particular thing, it says that like in first case, it says stock of cards are valued at cost, which is wrong, cost or NR which is lower on FIFO basis and includes all applicable overheads in bringing the inventories to the present location conditions. Work in progress is valid cost. Work in progress is valued at direct material cost and appropriate cost of completed process. So now when you look at these particular things, in many cases it says it valued at raw material cost. See, here says work in progress is valued at raw material cost, again wrong. Work in progress shall be valued at cost plus the cost of conversion. Though work in progress means certain part of the process is already completed. So percentage of that particular cost of conversion of which is being incurred to arrive at that particular stage, it has to be added here. So the cost of inventory is not only the purchase cost, it also include the cost of purchase plus cost of conversion and other costs. So all the costs which are required to be there to arrive at this particular location conditions, they all have to be added. That is one part which is required clearly. And second part is that the cost should be or the inventory shall be measured at cost or NRV, whichever is lower. So this is what we basically we need to look at here. Next point, I think one question. Okay, is depreciation should be taken? Anurag, here what happens that AS2 and AS10 they both inter alia talks about the situation that in case of something is required for which the depreciation, like for example, there is a construction is going on in one of the new site. So construction work in progress is going on now. Whether this particular machinery which is being used for that particular site, and that site is first question is the site is inventory or not. If that particular site or the inventory which if it is inventory which qualifies to be inventory and is to be sold, and for that that producing inventory you are using a basic machinery which is your own assets, and then depreciation on machinery shall form be part of these particular things when you talk about the this weighted average cost and finished goods and WRP. Let us look at the second case of inventory AS2, that incorrect disclosures of formula for inventory from the annual report of some of the companies following accounting policies have noted. Inventories are stated lower of cost and NRV. So now here the first part is correct, but it says that let lower of cost and NRV. Now second part says that cost is determined on weighted average or first in first out basis as considered by appropriate by company. And second accounting policy which mentions that cost of inventory is computed on weighted average or FIFO basis. Now what is the non-compliance here? Bothra ji has mentioned that not correct should be one of the method. So basically here it means that yes, Bothra ji, you are right. It should be one of the method. You can't say that it is based on what is first line says that as appropriate by company. Now that means it is not certain. Are you saying that it is based or it is whatever company wants is done? So whatever be the basis, if there are two sets of inventory and you are having a separate formula for each set, so you mentioned that fact here. So ultimately, the stakeholder should be able to get the information which is correct, that which particular cost formula has been used by the company for the purpose of determining the cost of inventory. That is what is required here to be clearly. So yeah, Sagar Jogani ji कह रहे हैं कि company should follow one fixed method, and if the method is changed, it should be set accordingly. Exactly, Sagar ji. So basically, आपने जो method follow किया है, आपको वो method clear लिखना है. अगर आपने जो method follow किया है, ये वो methods, you have followed two different methods for two different class of assets, class of inventory, like raw material different, WP different. Then you to mention that for raw material this is the method, this is the cost formula which is used. For WIP, this is the cost formula which is used. So whatever disclosure which is mentioned, that disclosure should be clear. It should be clear where the investors, reading person should be understand that what is the cost formula which is used for the purpose of measurement of cost, and then cost of NRV which is lower. That is what the measurement which is done by the company. Okay, Bothra ji asking question, for two finished goods, can we have a two method? Sir, not two finished goods. Yeah, but it's a two separate class. Like for example, if you have like seven finished goods where you feel that this method is most appropriate because it is a perishable nature, and another finished good is such which is a normal thing where you can go by other methods because that method appropriates the actual cost. So your methods can be different for different class, but however, there should be a reasonable basis behind having a separate cost formula for each different class of the finished goods. Okay, any other questions here? Fine, we'll go ahead here. So para 26 says that the financial statement should be disclosed A, the accounting policies adopted in measuring inventories, including the cost formula used. So it says that you have to disclose the accounting policies adopted in measuring inventory, including the cost formula used. So cost formula that we discussed, it should be very clear which is cost formula is used for measuring the inventory. And yes, so you have to be very particular on the cost formula, particular about the measurement lower of cost of NRV. Also, it will be particular about the what cost of inventory includes. It includes the cost of purchase plus conversion plus other costs. So this should be the very clear when you talk about the accounting policy. Yes, I think Bothraji mentioned that yes, like for traded goods can be have actual cost. Some traded goods you can have actual cost, and but however if the cost formula is different, actual and estimation is one way of measuring the cost. And cost formula when we talk about is a first in first out, weighted average, last in first out. These all are the cost formula. So you can have only one for particular class of the goods. You can't have a two because it's not possible only. So one particular class of goods based on the nature of the item. So when you say traded goods, yes, for traded goods you can go by the cost, which can be a FIFO basis. In my view, FIFO is better for traded goods, or it can be weighted average also. Because traded goods, each items are different, so you're not sure about the which item you're selling. So in that case, FIFO, because for you the average cost is more important than the which item is going first and last, because they both items are interchangeably used. Not sure when which item comes and which item is going here. So where sold goods are identifiable, then it is compulsory to go for FIFO. Sir, it can be FIFO or weighted average. You can have either a FIFO or weighted average because it is based on how it is being done. Now, whether the cost which is lying at the end of inventory, which particular cost is approximate the actual cost. That is the main objective, to identify which formula should be done. So generally FIFO or weighted average is being used. Whatever formula is appropriate to the inventory and to the management, that can be done. However, very important thing is that any formula which is to be used should be consistently be applied. Okay, Bothraji, thank you for writing. Okay, it gives a lot of comfort that yes, you are there and you are satisfied with my answer. We'll go to the next point. Any questions before we move to AS3 cash flow statements? Right. Okay. Now let us look at cash flow statement. So as we all are aware that under cash flow statements, the objective is to divide the whole movement of cash into three parts. Part A talks about the operating activities. Part B talks about investing activities. And part C talks about the financing activities. So financing, investing, operating, these three activities are three parts are there under cash flow statements. Now, when you look at this particular piece of statement, which has been generally not used by the lot of investors. However, the exposure draft is underway under IFRS, under IASB, and then it may change the way the financials are being presented. Then these cash flows can be more interpreted very easily in the futures. But at this time, the most important thing is that if you really want to understand how the cash is coming from which particular part and how the cash is being used, this is one of the very important statement which can lead you to a lot of many informations. Now let us look at this particular statement, what it is done. It is written that for the cash flow statement given in the annual report of bank, it has been noted that net increase or decrease in investment, increase or decrease in investments has been disclosed under head cash flow from operating activities. Further, it has been noted from the note on the investment that such investments also include held to mature investment. So first point is that it's a bank. For bank, investments can be a part of the operating activities, because in general case investment cannot be part of the operating activities. Now what is your response here? What do you feel is the non-compliance as far as this accounting policy is concerned? Yes, Anurag ji has mentioned one fact that yes, generally cash flows are like a fund flow where you need to look at the different balance sheet. Yes, we look at the balance sheet opening, closing, and both the balance sheets movement is being captured. And in certain cases, we look at into detail to look at what is the actual amount of cash outflow, cash inflow is done. Because when you look at the movement of balance sheet, it is more of like a net amount. And how certain cases there is a need to have gross of the inflow and outflow both. Tejas Gandhiji says that raw materials are not from. Okay, sir. I think about AS2. Can you please answer about this AS3 particular point? That what do you feel is the not correct in this particular disclosure? Manish Jajuji says that held to maturity is shown in as AS13. Okay. Anurag ji, you can also when you reply you can say everyone. So when you say everyone, everybody can look at your response and then they can also learn from your responses. Okay. So Manish ji says held to maturity to be shown in AS13. Fine. I think very important relevant point, sir. Talks about basically investment accounting. However, we are focusing more on cash flow statement. So it is more of like account is done by AS13, but the cash from these accounting items we need to put as a part of AS3 and a cash flow statement. So whether the showing in operating activities is correct or no. Yeah, Anurag ji mentioned that operating and investing activities disclosures. Okay, fine. So let us look at the reason why this is not correct. For bank, first thing is that operating cash flow from operating activities are generally cash flow from investing can be a part of operating activities. However, when the investments are held to maturity, that means you are not going to buy and sell for the purpose of use in operations. If the investments are to be held for operating activities, that means it is not for maturity. Held for maturity means it is going to be held for 3 years, 5 years, 7 years, 10 years, as per the maturity of the investments. Now, in that case, it doesn't qualify to be the part of the operating activities. So, this particular part, investment, this particular should be the part of my investing activities. Only held for trading can be part of my operating activities because I need to use this investment by self investment, whatever cash flow comes, that cash can be used for the purpose of business, for operations. So the point which has been discussed here is that it was viewed that only the cash flow arising from accounting policies adopted in measuring inventories, including the cost formula used, should be classified as cash flow from operating activities, and those acquired on account of sale or purchase of held to mature investments should not be considered as cash flow from revenue generating activities of bank due to its long-term nature. Such activities are in the nature of investing activities and therefore should be classified as cash flow from investing activity. So basically, this makes a point that you need to look at the nature of the activity. by the nature of this particular activity, whether that has been used for the purpose of operations or for as about investing. When the investments are held to maturity, it's just the point that these are primarily for the purpose of investing activities, not for operations. Now, before I look at the next question of Manish Jajuji, let me look at the question of I think Mr. Gandhi ji has asked one question earlier on inventory. Yeah, Tejas Gandhi ji has asked question that raw materials are not for sale. In normal circumstances, it is not valued at NRV. Sir, basically, AS2 mentions the fact that the inventories should be measured at cost or NRV, which is lower. Inventories include raw material, work in progress, and finished goods. All kind of inventories are included in that. So when you talk about in general, yes, in general, raw materials are normally at cost because there is no point that the cost which I purchased it may be higher than the MNRV because this raw material is going to be converted into work in progress and then to be converted to finished goods to be sold to the third party. So in that case, raw material should be generally at cost. But when you look at the accounting policy, sir, we need to mention and ensure that the raw material is not measured at cost. It has to be measured at cost or NR is lower. But when you apply these principles, it may happen in majority of the cases the raw materials are at cost because in most of all the cases, in general cases, the cost is lower than NRV because ultimate purpose of purchasing raw material is to be consumed and that to be sold in the future. So that means, but however, accounting policy when you write down, accounting policy should be inventory to be measured at cost or NRV which is lower. I hope Gandhiji, it is clear to all of you. To you, please reply so I can go to the next point. Tejas bhai, I think it's clear to you. Okay, thank you so much, Tejas bhai. Next point, I think one question was from Manish Jaluji. Manish ji has asked question that the method for computing every in and out flow is many times not shown separately and only netting is disclosed, which is under disclosure. Sir, you identify very, very important observations, and that is correct that in many cases we notice that the cash flow is not disclosed as gross, which is requirement of the S3. For example, if I have like when I follow only balance sheet method, investment closing minus opening, it is not correct. Financing part, loans closing minus opening is not correct. So loans obtained during the year, repaid during the year, investment made during the year, investment sold during the year, they both need to be mentioned separately. That is what is required, and that is required. If it is not done, it is a non-compliance. So, Manish, your point is well correct, and I think that is what we all should take care when we apply these particular standards. That our cash flow statement should have the grossing of the figures, not netting of the figures. Let us look at the next point of ES3. In the note on administrative and other expenses, there is an item exchange fluctuations net amounting to rupees XXS. However, the same has not been adjusted to determine cash flow from operating activities in cash flow statements. See, basically what happens is when I look at other expenditure, there was a basically forex fluctuations. Now, when you look at the formula of these particular activities, okay, what is your view? How it is? Do you feel it is incorrect? Anurag Mishra ji replied saying that this action difference may be due to financing or investing is right, fine. Sir, let us assume it is for operating activities. That is correct. Because the company is into the export of the sale. An export of sale is basically in terms of the company doesn't have the foreign currency borrowing, they only export sales. So in this export sales, it is basically in operations only. Any other, but however, there is some mistake here because it is not adjusted in operating activities. Then what? So Anuragji, your view, your response is right, saying that it is a part of operating activities. However, when you look at this particular case, it says that this item of exchange fluctuation is not adjusted. See, in cash flow from operating activities, let us look at how it is being computed. Operating, investing, financing, operating activities, starting point is what? Starting point is profit from profit loss account. Now from that profit, we have to do adjustments for add or less for non-cash items. Now foreign exchange fluctuations, if it is a part of, it can be part of non-cash item because you have a foreign exchange receivables, payables, outstanding as on balance sheet date. Now, as per AS 11, if you have monetary items, then you need to do translation of foreign currency balances. Now, translation of foreign currency balances, foreign exchange gain or loss, is a part of profit loss statement, and that item is not a cash item. So, when you do computation of cash flow statements in operating activities, when you start with the profit as per P&L account, you need to add all non-cash items. So foreign exchange fluctuation should also include an item of translation gain or loss, which is not a cash item. So that should also be added when you compute the cash flow from operating activities. So that was the observation here, that non-cash items, if any, is to be added here. It is viewed that the entire amount cannot be considered to comprise of only realized. When you're having the monetary items as a reporting date, which are in foreign currency, there is bound to have some items which is unrealized or which is a non-cash items in foreign exchange gain loss, and that adjustment should be done when you arrive at the cash flow from operating activities. That was not being visible on the face of the cash flow statements. So that was the point which was being done here. The next point is on, in one of the enterprise, the components of cash and cash equivalents as reported in the balance sheet includes cash in hand, cash at bank, earmarked bank, balance against LC, gratuity, superannuations, unpaid dividend account, interest accrued or fixed deposit, and total of these components matches with the closing cash and cash equivalent as reported in the cash flow statements. Now, what is the error what you find in this particular cash and cash equivalent amount in the balance sheet and also in cash flow statements? Yes, Anurag ji mentioned that cash equivalent problem which are not readily realizable. Any other response? There are 114 participants, so I request each one of you to please basically take part here. I understand that you all are maybe at work from home or work from office, and you are at a place where you may have been struggling with a lot of other issues, and your staff articles may be coming and asking you a lot of questions. Client may call you, but however, when we have the liberty to attend these sessions from the home, liberty to attend these CP hours from home, I think that is very utmost for important for all of us to ensure that we really learn it. Otherwise, the sincerity of the when you attend person and when you're in office or home is different. So let us have more interactions, and I request each one of you to please take participate in this interaction process, and then we can gain this confidence. So others, anybody who has any other views, what is the wrong here? Okay, I will go ahead because of that the time. I don't want to spend more time on that aspect. However, I want all of you to please basically, yeah, Bothra ji. I think there are few persons who are very common. Tejas bhai, Bothra ji, Anurag ji, and I think they all have been taking a lot of part here. Bothra ji says that accrued interest on FD is not realizable. Yes, sir. I think the most important thing, you both have hit the nail. That is the most important, the cash equivalent. We need to look at what is the definition of cash and cash equivalent as far as AS3 is concerned. Uh, Cash and cash equivalent shall not include certain items which have been mentioned here. So it was observed that the balance of cash and cash equivalent as reported in the cash flow statement is same as for balance sheet. Further, it was noted that the components of cash and cash equivalents that it includes balance of unpaid dividend, accrued interest on FD, and earmarked balance against LC, gratuity, and superannuation are not readily available with the enterprise funds used. Thus, the same cannot be included in cash and cash equivalent. So, it should readily available if you want to classify as a cash and cash equivalent. That is not the thing which is done. Hence, cash and cash equivalent shall not include these components which are not really available. That was the non-compliance of AS which was to be notified. Now, before I proceed further, I would like to draw your attention here, sir, that government has been government is strictly informed to all regulators to really be very cautious as far as the review of financials is concerned. And over the period, there is ought to be many notices going to be issued to all the auditors of the companies in this non-compliance of areas. See, now the government is equipped with the all technology, all system is there. Plus, they also recruited many staff who are chartered accountants who can understand the financials. They understand account standards, and they have been given a task specifically to identify the errors in the financial statements. So please ensure that you all are equipped with this requirement. You all understand and ensure that in your offices the system has been ready and your staff has been trained to see that the non-compliance is not there. So it's my humble request to each one of you to please take up the challenge and to ensure that the AS compliance is properly being done when we finalize the financial statements and when we do audit. AS5 prior period items. The accounting policy on prior period adjustments is as follows. Prior period expenses and income are included in respective heads of expenses and income in the profit and loss account. Now, what is the wrong here? Can you please give your view? Others, please respond. Anurag ji mentioned that yes, to be shown separately. Tejas Bhai also mentioned the same to be shown separately. Fantastic, sir. Paragraph 15 of AS5, which we need to go through. Basically, it says that it requires a nature and amount of prior period items should be separately disclosed in the statement of profit and loss in a manner that their impact on the current profit or loss can be perceived. Thus, a policy regarding prior period item is not in line with the requirement of AS5. So, AS5 mentioned that if you have a prior period item, you need to disclose separately nature of prior period item and the amount of prior period item. That is what is required. So when your accounting policy mentions the fact that you included the respective head of expenses and income, I think that is not the correct one, and we need to be very cautious as far as prior period item is concerned, because these may be treated as a window dressing where the financial statements may have been ignored by the company only for the purpose of ensuring the accounts are right and they exactly match as per taxation angle also. So this we need to be very cautious about the prior period items. Let us look at separately. Next point. In the annual report of certain companies, the following items of income or expenses have been shown: the statement of profit and loss under the head appropriations or below the line items. 1. Provision of earlier year's taxation, and 2. Write back of debts and sales tax dues. These have been shown separately. Now what is the issue here? What is the error here? I can see so many CAs here. I would request please take part here. The purpose and objective with which the Anurag ji has organized this session, and with the objective which I have come here, I would like to ensure that this has been fulfilled properly. For that, all your participation is very critical. What you feel is basically the uh, different or which is error as far as this tool is concerned. Okay, let me just go through. Let me just take this particular point ahead. So here it's mentioned that they're shown in the statement of profit and loss under the head appropriations, means below the line. See, in profit and loss there are two. One is the profit before tax, then appropriation is there. Now these items are not of appropriations. These are not appropriation. These are the normal current period my profit and loss. It is not my appropriation line items. Yes, Tejasbhai, you are right that it doesn't form part of appropriations. So it was viewed that the provisions for earlier years taxation is an expense, whereas write back of debts and sales tax dues is an income, both of which should be included in the determination of net profit for the period instead of showing as appropriation or below the line item. There are something which cannot be taken as what appropriations, uh, which would result in overstatement or understatements of current year's net profit. Further, it was not clear whether such liability or reversal thereof has arisen as a result of error or omissions. Now, when you talk about a right back of dues, sales dues, provision of earlier taxations, if it is an error, then it's called then it is a different accounting treatment at all. If it is not error, then yes, you need to include as a part of your normal current year's profit. However, if it is error, then the account is different. So that was not clear that how is it error or is normal case. So even if these items are considered as prior period items, this should be disclosed in the statement of profit and loss in a manner that the impact of the current year's profit can be perceived as per the requirement of paragraph 15 of AS5. That is what is disclosure requirement, and you cannot take as a part of your below the line items. It is not an item of appropriation, it is an item of your main profit of the current year. Yeah, Mohammad Javed ji has asked question, interest income on which TDS deducted to be matched with 26AS or reduce interest expense from interest income and show net interest income. Sir, you asked very critical and very important questions about netting of question. So can you net off income with expenditures, with interest or any other expenditure or income? The answer is that netting off is allowed. See, now you may ask me a question in which paragraph is written, how it is not written in any paragraph. We need to look at the framework of accounts under AS framework. And under AS framework, the principle says that the real nature of item will come in picture only when they both are done gross. So there are principles when can you net off. So in general, all transactions should be gross only. So when to net off, there are principle that principle will be to if they arise from the same kind of transactions, same nature, same operations, same item, then it can be net off like foreign exchange general loss. However, when it is from a different nature, like here in your case, there's interest expenditure which is from my loan or borrowing which I've done, and there's interest income from basically my investment in some mutual investment, some kind of things. So the interest income and interest expenditure arising from both different angles, hence they both should be disclosed separately, gross. No netting off should be done for this case. Mohammed ji, I think your query has been responded correctly. Are you satisfied? Yes, Javed ji. Javed ji, if you have any query, please let me know. We can discuss, or we can otherwise I can move ahead. Okay, I'll just move ahead, Javed ji. I think you may. I assume that your query has been responded appropriately. Let us look at next point. Yes, 7 construction contracts. The significant accounting policy related to construction contracts stated as below. Forward revenue is accounted on the basis of running bills raised and approved by clients. Revenue expenditure is accounted on accrual basis and when, as and when it is incurred. Now, please identify what is the issue here. Yes, Anurag ji, POCM method, percentage of completion method, POCM. Yes, great. Anything else? POCM for what? POCM for revenue or cost? Revenue. Okay. Anybody has different view? Any other thing which you identify here? Fine. See here we will look at it's a POCM for both revenue and cost to be done because yes, Sanjay, by as per completion method, percentage of completion method, we should do it. If you look at this, it was observed that revenue has been recognized based on bills raised and cost has been accounted as and when incurred. Whereas paragraph 21 of AS7 requires to recognize revenue and cost based on stage of completion. See, once you recognize revenue, you cannot have a different method for cost. Otherwise, the profit may not be correct. So, revenue and cost both should be recognized based on a stage of completion of contract activity as on the reporting date. So that is what is requirement here. And thus the policy regarding construction contract is not in line with, yes, Mukesh bhai, Mukesh ji, the both should be based on the POCM, then only the profit is appropriately being captured in particular period. So the policy of the accounting is not correct. So when you look at these particular things, you understand that how critical is to disclose, how critical is to look at the notes on account disclosures. If it is not done appropriately, it may lead to the wrong impression. It will give the completely wrong thing for the stakeholders, and then it is called non-compliance of AS. From AS7, from annual report of company, it was noted that the company is involved in construction business and its schedule of inventory also include an item of job in progress. However, no other disclosure was made in the financial statements. See, basically, when you look at your in revenue says that the company is in construction business, then in the inventory schedule you're mentioning that there is job in progress, work in progress is that. Now, under A7, so when you say that under A7, it says that if it is a construction revenue, construction contract revenue, it requires you to provide a disclosures. So paragraph 39 of AS7 talks about the disclosures which are required to be done. And as per that, paragraph 39 of AS7 says that the company should disclose the aggregate amount of cost incurred and recognize profit less recognized losses up to the reporting date, and B, the amount of advances received, and C, the amount of retentions. So that is what is required to be disclosed even if you follow AS7. And when you look at the company's accounting policy, it mentions that AS7 is there. However, the disclosure of para 39 was missing here. So that means what it is not appropriately, adequately complied with. Let us look at another part, AS9 of revenue recognition. The accounting policy of revenue recognition as given in the annual report of company. Inter alia states that revenue from online educational services, if charged, is recognized upon receipt of subscription fee. In case of non-refundable, otherwise apportioned over the subscription period. In the annual report of another company, the following accounting policies have been disclosed. Revenue from online education services is recognized upon receipt of subscription fees. Now, what you feel is basically incorrect here. Yeah, Anurag ji, you mentioned that periodical revenue time basis very good. Any other response? So we need to refer to para 7.1 of AS9. It says that the period when the services are rendered should be considered for recognition of revenue. So period when the services are rendered should be considered for revenue. Accordingly, for revenue, it should be deferred and recognized over the period when the services are rendered. It was further viewed that the subscription fees for online education services should be recognized a portion over the service period. So when the there is a concept of at the point of time and over the time. So at the point of time when it's done, at the time you need to recognize when the particular point or time is over, when the work is completed. And over the period of time, which is generally in case of services, when the service is provided over the period of time, then you need to defer and amortize that period over the period of services it is rendered. So it should match. As the cost is incurred, it is being debited in the account. So revenue should also be deferred and should be taken as and when services are rendered based on the percentage of completion, based on the period of service, based on the milestone which is defined. Accordingly, the revenue should be recognized. Let us look at the next point. From the annual report of a company, it has been noted that the company has recognized as income the entire cost of garments destroyed by fire under other operating income, stock loss claim, based on filing of insurance claim. With regard to partially damaged stocks, the related inventory has been valued at net realizable value and insurance claim against the same is taken as other income. Insurance claim against loss of fixed assets has also been recognized based on the claim filed with the insurance company. The note further states sales income has been recognized as per AS9. Now, please provide your response. What you file is the incorrect here. So companies recognize income as income, entire cost of garment destroyed by fire under other operating income based on filing of insurance claim. With regard to partially damaged stock, the related inventory has been valued at a net reserve value and insurance claim against the same is taken as other income. Insurance claims against loss of fixed assets has also been recognized based on the claim filed with the insurance company, and the note says that this is done as per AS9. So first we need to look at the AS9 compliance. Now whether the insurance claim money is part of my AS9. AS9 is for revenue recognitions, and revenue recognition is with respect to the operating activity. Now whether the loss and filing the insurance claim is part of my revenue generations operating activities, my view is no. So if it is not part of AS9, this kind of disclosure may not be done. Now let us look at then how to basically recognize the income or the amount to be received on the insurance claim. So basically here it is required that it mentioned that the income was
ऑनलाइन भी या तो फाइल कर सकते हैं
the income was
देके फाइल उनके सीए के पास ही तो है वो
अनिश जी आपका म्यूट कर दीजिए अनिश अग्रवाल जी
वो दूसरे सिटी में उनके सीए के पास ही है तो वो आ जाए तो उनसे वैसा बात कर लो
पार्टिसिपेंट को म्यूट कीजिए प्लीज
बोला कि मैं फाइल भेज देता हूँ
Okay, thank you so much. I understand the task of admin is very critical when it is on Zoom platform because everybody can unmute, everybody can speak when it's required. So it's every member is to be ensure that when you are there in this meeting, any meeting, you need to take care about your own because admin may not be able to do every time. However, it is a responsibility of each and every member to see that they remain unmuted. There is nothing which is done when it disturbs others. Fine. So let us look at the AS9 requirements. This is not my income, so it is not from my revenue from my normal operations. So in that case, we have to ignore these things. However, how to do recognize it? Here it says that it is recognized based on filing of insurance claim. So is it correct? Because once you file insurance claim, can you recognize? So for that, you need to look at the probability of the insurance claim, and based on the probability of the insurance claim and the amount to be receivable, the amount can be recognized. So the response which is that it was noted that insurance claims do not fall within the definition of revenue. As I will discuss that revenue is for the operations, operating activities from the normal operations. So, however, it was viewed that in the case of sale of goods or rendering of services, the recognition of insurance claim also requires that the amount realizable is measurable, and it is not unreasonable to expect ultimate collection. So wherever you recognize any income, even if it's not revenue, other income, the ultimate collection and measurability of the revenue is the most critical aspects. So that point should also be highlighted, that it is based on ultimate collections and the probability of the amount to be collected and the amount which is measurable on estimation. Accordingly, recognize insurance claim at the time of filing of the claims without considering the uncertainty related to its measurability is not appropriate. According to the view that recognition of revenue at the time of filing of claim is not in line with the principle of AS9. So it means that basically we need to look at first point is that it is not my revenue. However, we can apply the principle of AS9. It says that you need to look at the probability of the recoverability and the estimation is involved for insurance claim. Because filing of claim is not doesn't sustain you with the amount to be received. That all things one need to consider when you recognize income, and that should be disclosed appropriately in your notes and account. Now, Tejas Bhai has asked a question that is separate disclosure as extra item. Sir, basically, the extra item may or may not be there. It is based on the materiality, nature, and also the quantum of this particular clause and how it is being affected to the company. So in all cases, extraordinary may not be there, because if it is there are like 1,000 godowns, and in one of the godowns there is some loss and some claim is done, then it may not be extraordinary. It may not be exceptional also. However, something which is of material, it may be exceptional, it may not be extraordinary. So in my view, it can be exceptional item because it may not be extraordinary item. How it can be exceptional, provided that the quantum and nature of the particular item is such that it requires you to recognize separately on the financial statements. Okay, now let us look at AS9, revenue recognition. The accounting policies regarding recognition of dividend income has been disclosed as follows in the annual report. 1. Dividend is accounted as and when received. 2. Income and expenditures are recognized on accrual basis, except dividend on shares and units of mutual fund, which are recognized on cash basis. Yes, Anurag ji has been prompt enough to come with response. It says right to receive is required. Yes, Anurag ji, you are right. And the response on dividend. Yes, Sanjay bhai, you are absolutely right. Right to receive should be established. So these are the accounting policy which are the critical and which cause the concern for us. So it was observed that dividend income is recognized on receipt basis, while paragraph 3 of AS9 requires recognition of dividend income when the right to receive payment is established. So we need to look at right to receive, and the right to receive payment is established when it is declared and you are eligible to get the dividend. So receipt of dividend is maybe postponed. It may be in the another year, but how right to receive dividend is when that it is declared, it is approved, then it is called right to receive. So the accounting policy should not be based on receipt. It should be based on the right to receive, not based on the receipt basis. Yeah, Anurag ji, this year it is important because in current year dividend is taxable. Very good, sir. Yes, because we need to look at the accounting policy. We need to look at how it is accounted, because there is a lot of change in taxation aspect as far as dividend is concerned. Now the dividend is taxable after 1st April 20, and it was not the case earlier. So we need to look at very, very carefully the accounts, how it is being accounted. So if the dividend is not received, still it has been declared by 31st March 2020, then it should be accounted once the right to receive dividend has been done. Otherwise, it may have the issue of case compliance. Also, there can be issue of the basically taxation aspects. So that's why you need to be more careful when you talk about the accounting policy and also the real accounting in your financial statement. Sometimes I've seen that accounting policy is something different and the accounting is done differently because the client and accountant doesn't understand accounting policy. And we look at accounting policy, we change accounting policy, and then it's done as per AS. But they may not be doing AS. They may be following something differently. So we need to be also cautious that that it has to be synced. Your accounting and accounting policy both should be synced, and then once a while interaction with the accountant, discussions on certain very important principles of revenue recognition should be there, where they understand that how this will be done. Like AS11, in AS11, I have seen many cases that foreign exchange fluctuations restatement is not done. Even if the accounting policy mentioned that monetary items are being translated at closing rate. That is accounting policy mentioned, disclosed under annual report. When you ask an accountant that have you done translation, the answer is no. They don't know if the translation is required. So accounting policy gives some information that it has been translated. However, under accounting it is not being done. So they both are not in sync with that, and these issues may arise in certain legal and technical stuffs where the issues can be caught up by the regulatory authorities. Sanjay ji has asked question that for eligibility share as on X dividend date is counted and should be accounted. Yes, Sanjay ji, which I understood your question that you are asking that you need to look at the number of shares as on the date of declaration of dividend. Because when the dividend is declared, that time there is some period where the transaction cannot happen. And if you are eligible as of that particular date, yes, you're going to get the dividend. You have right to receive dividend. So if you have shares at that time, then yes, you should recognize the dividend. What you can do additionally, you can also look at the subsequent events, that whether the company has really received the dividend or not. So if, for example, dividend has been declared on 20th March, so you may also look at the on 10th May, 5th April, also if the amount has been basically received. So if the amount has been received, that means that you have right to receive dividend on 20th March. So in that case, you need to establish an account on 1920, because on 20th March, you have right to receive dividend, and your subsequent procedure provides you comfort that yes, the dividend is received and you are really right to receive dividend as of the particular period. Yes, Anurag ji, right, record date is important because that determines the eligibility to get the dividend. That should be taken into consideration when you talk about the right to receive dividend or not. And further, you can confirm with the subsequent review procedure. So, para 13 of AS19 says that dividend income should be recognized when the right to receive payment is established. The following accounting policy on revenue recognitions have been disclosed in annual reports of some companies. Revenue is recognized when no significant uncertainty as to measurability or collectibility exists. That is first point. Second point, revenue or income and cost or expenditures are accounted for on accrual basis. And third, says that there are three different companies, three different policies which are combined together to provide you the inputs, that these are the companies which are discussed in this fashion. And sales are accounted for on dispatch of products. Now, what is wrong here? What is incorrect about here? Anurag ji mentioned the fact that risk and reward is important, because we all have learned from beginning that significant risk and reward is transferred than at the time the revolution was recognized. Fine, that is one point. Point two, it may be based on cash accrual. Very good, Sanjay bhai. Revenue or income and cash expenditure accounted for accrual, but it doesn't talk about the measurability. It doesn't talk about the timing of recognitions. So, sir, I think your question, if it's about cash or accrual, basically, if the company doesn't have any revenue which is on cash, it has to be on accrual basis only. So in general cases, all it is accrual basis. Cash only in exception is allowed, others not. Uh, During exports, many times goods are lying at port. Whether that should be reversed. Fine, we'll discuss about that point Anurag, later on. Let us first look at this particular accounting policy, then I will come to your point. So here when I look at, it says that we need to look at the conditions for recognition revenue. Paragraph 11 of AS9. Now in that case, it mentioned that the timing of recognition revenue. So it's measurability, collectability, and timing of recognition revenue. All three are very important for you to recognize revenue. So when you write the policy of revenue accounting, you need to mention the fact that revenue is recognized when basically what is the time, at what point of time. So whether there is significant risk and revenue is one. Second thing is that measurability, and third is the collectability is probability. So these all three conditions are required. So in all these three cases, that is not clear that how the revenue is recognized. So that is what is not correct, and one need to refer to the AS9 para 11 non-compliance. And in case if this is non-compliance and if you're auditor of the company, you need to ensure that either you change the accounting policy, provide disclosure correctly, or you may have to provide the qualified opinion or disclaimer or official matter or modified opinion based on the material items, based on the way it is being covered here. So that is what is being covered here. Now let us look at the question which Anurag ji asked question. I think during exports, many times goods are lying at port. Whether that should be reversed. Let us take a case where on 25th March 2020, the company has exported goods. Now, when the company has exported goods, then we need to look at the risk and reward. It may be at the port. However, if the shipment has been arranged, everything from the point of the when it is dispatched to factory. So if the X factory and all insurance, transportation, and everything has been taken care of by the purchaser or importer, then it may be recognized. But generally, in case of the export shipment, it may not be the case because generally it is FOB, free on board. If it is a FOB sale where the risk is transferred only when it is being shipped. So till the time it is shipped, it is lying in the port, the risk and reward is not transferred. In that case, the sale cannot be booked. So that is the revenue recognition which we need to understand here. Now let us, Anurag ji has asked another question. In Surat, goods dispatch are at risk of supplier till those are received by buyer. How revenue should be recognized, especially problem during COVID times? See, during COVID time, what happens that first we have to be very cautious on all the sales from 19th March 20 to the 31st March 20. From 19th March to 31st March 2020, if any sales is recognized, you have to be more cautious because that was the period where there was a complete lockdown across India. So you can do complete scrutiny, ledger scrutiny, reviews of the sales ledgers to look at all the sales happening in this period. If the sales has been happening in this period, you need to get additional evidences to ensure that the sale has genuinely been happened and the risk and reward is transferred. However, if the goods has been transferred during the period, like let's say case from 20th March to 31st March, the sales cannot happen, the goods cannot be dispatched. If the goods have been dispatched on 18th of March 2020, which is not reached to buyer, then in that case we need to also look at the additional evidences to understand that whether the sales has all really taken place or not, whether the goods are reached to buyer or not buyer. And then we need to look at a study of the material items, material sales in last month of March, and then from that you need to look at whether you need to recognize the sales or you need to recognize as the inventory in transit, or you need to recognize as the finished goods at the particular company premises. So based on the real scenario of these particular items, the revenue may be recognized. So March month, particularly from 10th or 15th March 20 onwards, all sales shall be recognized, all sales should be scrutinized to understand compliance with the AS9 requirement. So this particular point, we need to look at the disclosures of timing of recognition of revenue, probability of the collections, measurability of these things. They all need to be written and provided, disclosed appropriately in your accounting policy. Let us look at AS10 from accounting for fixed assets. From the annual report of a company, it has been noted that a significant amount has been shown as site and land development during the year. However, no depreciation has been charged in respect thereof. Now, is there something which is you feel is not correct here? So on the fixed rate schedule, on the basically annual report, you find there's a significant amount which is there in site and land development. No depreciation was there. Site and development cost opening, then no depreciation, closing, opening, closing, opening, closing, no depreciation, no amortization on that. So is it okay? Is it fine? Can we have a separate line like site and land development cost? Anybody, please, can you respond? Sanjay ji, yes, at least new for me, that's good. You are taking participations and giving response is very important thing. Only cost, Jitendra, Mehta ji, yes, Mehta ji. Only cost, fine. If new expenditure. So you are saying Mehta ji ke depreciation charge nahi karna hai. That's what I understand from your response. Okay, fine. Any other? Let us look at the para 18 of AS10. Para 18 of AS10 says that specifically directly attributed cost would also be included to the cost of fixed assets. It may be noted that site preparation would be required for developing land as well as construction of building and installation of plant and machinery. Accordingly, it was viewed that site preparation cost comprising mainly of uprooting of any existing structure, leveling, clearing and grading incurred to prepare the land for its intended use or for construction thereon should be suitably appropriated to land, building and plant and machinery and capitalized as part of the cost of respective asset as per record of AS10. Sir, we need to look at here is that any development site cost has no purpose. And if you're only lying land, I understand that. But if it is only a site land, there is some reason that you may have to basically apportion to land. If it is for land, then fine. If it is for building, you want to construct a building, then you have to apportion to by building. If you want to, if you incur for building for some machinery to be laid, then it is to be apportioned to plant and machinery. So AS10 paragraph 18 gives the information that all directly attributed cost shall be capitalized to the item of cost. Now, when the site development cost has been incurred, which even in example of paragraph 18, it also mentions the site development cost as a separate part of the example of the directly attributed cost. So if there is a part of my directly attributed cost, then purpose for which the cost is incurred to that particular item shall be capitalized. It shall be part of the particular item for which it has been incurred, and the depreciation thereon shall be start as per the depreciation of that particular item for which this particular expenditure has been incurred. You cannot have that expenditure lying as a separate item without apportioning to anything, and then no depreciation will be charged. So in that case, it may be a case where the cost is higher than that particular amount to be recoverable. So this has to be apportioned to the item or nature of item for which this expenditure has been incurred. Let us look at now the next bunch of the items on AS 11 to 20. First, AS 12 grant was received for depreciable asset as recognized and disclosed as capital reserve and subsequently transferred from capital reserve to the statement of profit and loss. Following are examples of somewhat accounting policy. Okay, before that, let me just take the example of question by Sagar ji. I think there are two questions. Fine. Manish ji has asked question that is the contribution given by Gujarat State Cooperative Bank to DCCB with remark to take. Sir, can you please explain your question, Miss? What is your exact question? I'm not able to get your question. What is your query? I will go to the next question till the time when you clarify the question.
Hello.
Manish,
Hello.
yes. Yeah, Manish.
No. What Gujarat State Cooperative Bank is doing is writing to DCCB that take this amount in general reserve. So if I see to grant government grants, or if I read in this fixed assets accounting standard, then is this required to be deducted from fixed assets cost, the grant which is given by as a contribution to be kept in general reserve?
Fine, sir. I understand your question. I will deal with the question later on. Okay.
Thank you.
Sagar ji has asked question related to AS10. So I will deal first with Sagar ji's question, then I will come to your AS12 questions. Can the interest cost incurred for purchase of fixed assets be added to the cost? This is a very relevant question, Sagar. I think we will be able to cover this question in AS16 and AS10. So for capitalization of interest cost, we need to look at AS16 and AS10. So I will just keep your question on hold and I will deal with when we refer to AS16. Now coming back to this AS12, and then we will also deal with the Manish's question also. Fine. So here basically the point was there, the grant was received. Let us say the example of accounting policies. Grant and capital subsidy from government is credited to capital reserve. Further, in accordance with the guidelines issued by ICI, proportionate amount to the extent of depreciation charge is being transferred to surplus in the statement of profit and loss in case of grant received in relation to acquisition of any asset. That is the what accounting policy in one of the company. Another accounting policy was that in case of depreciable assets, the cost of asset is shown at gross value and grant thereon is taken to capital reserve, which is recognized as income in the statement of profit and loss over the useful life period of assets. Now, when you look at the both accounting policy, they are mentioning the point that this is treated as a capital reserve for the fixed assets, which is a depreciable assets. Now, let us look at paragraph 14 of AS12. What it mentioned? It mentioned the fact that the subsidy received against a depreciable asset. See here in both cases it is a depreciable asset. Subsidy received against depreciable asset either to be shown as a deduction from gross value of assets to arrive at its book value, or treated as a deferral income which is recognized in the statement of profit and loss on a systematic and rational basis over the useful life of the assets. So there are two options given by AS12. If you receive a grant for depreciable assets, you have two options. Option one, you can reduce gross value of the assets by the amount of grant. So automatically your depreciation will be reduced by approximately. Second option is that you can treat it as a deferred income, and deferred income means that you need to take that income appropriately to the depreciation charge to P&L account. So two options. Option one, reduce the gross value of assets. Option two, you show as a deferred income in your balance sheet and take the proportion amount of income in accordance with the depreciation charge on the assets to income and statement account, profit and loss account as other income. Now these are the two options. However, when you look at this accounting policy, it mentioned it is credited to capital reserve. AS12 doesn't talk about taking this amount to capital reserve for these things. And same way also next point also, It is doesn't talk about taking to capital reserve, because that is not correct as far as this account is concerned. Now, as Manish ji asked question that Manish ji asked question in that case that it's so. I think Manish, your whether response is do you get my answer to your question that it is to be taken either as reduction in your fixed assets or to be shown as deferred income, and then you do take over a period to income if it is deferred income. If you reduce in gross assets, it will be definitely taken as a reduction in depreciation charge in a P&L account. That is what AS12 talks about. Manish ji,
No.
are you?
I want to draw your attention
Yes.
to another point which states that grants in nature of promoters' contribution. So here,
sir, okay.
those
that is
yes.
different. That is different game altogether, because this is no for that AS12 says capital reserve is okay. Right?
Yes.
So that is covered under the next slide, which I am taking here. Here the focus is on a depreciable asset. For depreciable asset,
No.
there is no option of capital reserve.
Is it so? Because where here State Cooperative Bank, it is specifically mentioning that the grant is to be credited to general reserve and not to that capital reserve, but to general reserve, which means that I don't deduct it from fixed asset. One thing. So you want to say that there I can write back as deferred income.
Yes, sir. Because see, what happens that sometimes I've seen that some regulatory or banks may be trying to override account standard principles. However, we need to look at completely on AS12. AS12 says that if the grant is received for depreciable assets, your two options: reduce the assets gross amount or show as deferred income. If it is for promoters' contributions, that is separate paragraph on that which allows you to take as capital reserve. But here the case which you talk about is not for promoters' contribution. It is more of like for depreciable asset grant is provided. So in that case, you have two options.
No, this okay. But then my question is that any asset which I purchase, whether it is depreciable or not, other than depreciable means land. So any asset I purchase, there is definitely one margin to be paid by promoter, and that is promoter contribution. This is I thought about, and then again, State Cooperative Bank is a parent to all these DCCB. So if it is providing grant, then I consider, to how they are accounting, I don't know whether they are taking it as an expense or whether they are providing it out of their capital. So if they are providing out of their capital, then why the banking sector should lose depreciation on that portion?
Okay, see, basically what banking the depreciation will be lost by the company. So what is happening here is that the purpose and objective. See, promoters' contribution is where the government is being ownership kind of thing. It may not be owner, but however it is trying to look at the case where they want to see that the promoter kind of they are installing the amount irrespective of the nature of the asset. For example, the contribution is such that they want to give to the company, and when they want to start as a promoters. So this is now the normally not the case, because in every contribution, government has some purpose. They are giving any grant or contribution for a purpose. Now, AS12 says that your income should be taken to P&L account so as to suit and match the purpose for which the grant is being received. Now, if the grant is received for depreciable asset, then as I mentioned, two options. If the grant is received for non-depreciable asset, in that case, it says that you will take as a deferred grant, and then you will take to P&L account to match with the obligation for which the grant has been received. So, if the grant is for a particular purpose, then to match with the purpose, grant should be taken to income account. However, there is no purpose and there is a reason to believe that is as a promoter's contributions without any cause, without any purpose, without reason for this grant, then it can be counted as a promoter's contribution, and in such case, you can count as a capitalism as per AS12. Manish ji, do you have any other questions?
Yes, I listen to you. Still, I am not certain about what treatment you are offering for this particular case of crediting to general reserve.
Sir, that
You-
is not allowed. Credit reserve is not allowed under AS 12, so that is not allowed. Either we may follow AS 12, or
Uh-huh.
if the company follows as per the direction of the bank, then as an auditor we may have to qualify or we may have to provide emphasis matter.
Okay, okay. Thank you.
Okay, thank you, Varishji.
This may be treated as under CAM. Key audit.
Anurag ji, key audit matter is actually little different than the qualification. Based on the nature, we can take a decision on that. See, key audit matter is a matter where has been taken to consider for doing audit of the company. Now, key audit matters may not be negative, but this is non-compliance. So, when it is non-compliance, writing only on a key audit matter is not correct. Right, so this also gives me opportunity to explain you about the key audit matters. See, basically, the key audit matters is a requirement in auditor's report. However, it is compulsory only for the auditor of a listed companies. Now, even if you are auditor of a non-listed company, still it is voluntary. It's optional, and you can opt and you can write down key audit matters. However, key audit matters are the matters which are considered by auditor while doing and while carrying out audit. Now, this may not be a non-compliance, it is more of a compliance items. So, key audit matters to be disclosed where, for example, if you feel that in the company in which you are doing audit, inventory is very critical, where you are giving importance, you write down in key audit matters. For example, if you have mentioned that there's a litigations are there, litigations are very huge, and you have dealt with the litigations while doing your audit, so that you can mention key audit matters. However, when there is non-compliance has to be there as a part of either if it's material, it is to be modified, or emphasis of opinion, it should be done as part of your auditor's report. So, in the case as Manish has mentioned that where due to directions of the bank, if you have done general reserve, which is non-compliance of AS 12, and if you feel it is a material amount, it should be taken as a qualified or emphasis matter. Emphasis matter is where the management can write down notes on accounts, they can explain the position, they can provide a reason why this is done, and then in auditor's report you can give reference to the emphasis matter, that is allowed as emphasis matter. But however, if it's material amount which affects the fluent fare, it is to be qualified.
What about the depreciation portion on this particular grant? This depreciation is allowed in income tax or not?
Sir, I am not expert on income tax. But
anyway, I mean, in books also, as per accounting standard also, say the nomenclature of capital reserve or general reserve is one thing. Had it been, अगर स्टेट कोऑपरेटिव बैंक कैपिटल रिजर्व के लिए लिखते तो ओके था क्या? तो ओके था?
नहीं सर, देखो मैंने आपको क्या बोला कि कैपिटल रिजर्व है कि नहीं है, वो पहले आपको वो देखना है कि ये प्रमोटर्स कंट्रीब्यूशन है कि नहीं है. See, that is what we need. Where you need to look at the terms of the sanction. You need to look at the reason of sanction for the purpose for which the amount is given. And अगर वो promoters contribution नहीं है,
वो reasons वो as a parent ही deal कर रहे हैं उसे, as a parent ही contribution दे रहे हैं.
Okay.
तो
अगर वो ऐसा
मेरे को वो promoter contribution लग रहा है. वो बोलते हैं कि तुम्हारे को रिकवरी में इधर उधर भटकना पड़ता है, गाँव में जाना पड़ता है, इसलिए ये हम contribution दे रहे हैं तुम्हें कार खरीदने के लिए, जीप खरीदने के लिए, जो भी
कार खरीदने के लिए,
हाँ डेप्रिसिएबल एसेट खरीदने के लिए, मतलब कार खरीदने के लिए, स्कॉर्पियो जैसा चीज खरीदने के लिए जो कि डेप्रिसिएबल एसेट है, और वो रिकवरी के लिए जरूरी है.
See sir, when it is
so ये प्रमोटर कंट्रीब्यूशन है या नहीं?
In my view, it is not a promoter's contribution, because when somebody gives you the money for purchasing some specified depreciable assets, it is not a promoter's contribution, because then the objective is clear. Promoter's contribution means where it is being just given without any object, whether it is specific reason. It is
तो आपका कहने का मतलब टोटल प्रोजेक्ट कॉस्ट में अगर कोई कंट्रीब्यूशन दिया तो प्रोमोटर कंट्रीब्यूशन है, ईयर मार्क्ड टू एनी एसेट है तो नहीं है. Okay. Yes,
exactly. If it is for a general reason, not for a particular objective, then it can be termed as a promoter contributions. However, it is be given for purchasing Scorpio or some other asset or machinery, then it is for depreciable asset, and then capital reserve option is not available. In that case, you need to reduce your depreciation.
चलो अभी clear, absolutely clear. Thank you.
Thank you so much, Manish ji. Accounting for government grants. Next point. Revenue recognized on receipt basis. For example of accounting policy, the company is registered as state government scheme. Under the said scheme, the company is entitled to receive capital investment subsidy, interest subsidy, employment generation subsidy, and remission of stamp duty and registration fees. This shall be accounted for in the year of receipt and/or crystallization. The company has been granted eligibility certificate under state government incentive to power intensive industries scheme. Under the state scheme, the company is entitled to receive incentive on energy charges, which has been accounted for on the books of accrual basis. So basically, there are certain cases where when you look at the time of recognition revenue, for the time of recognition revenue, the standard says that when to recognize. It should be recognized when basically. It should be recognized when basically to the extent such grant are related to the basically when the conditions are attached to the grant. If there are some condition attached to the grant are complied with, then you can recognize revenue. If there is no condition attached to grant, when it is received, you can recognize the revenue. So in the no cases, it should be postponed beyond the receipt. Once it's received, you have to recognize. Even if it's not received, the condition is being fulfilled, you have to recognize the grant revenue. So grants have neither been shown under other income, not deducted from direct expenditures. Further, although the nature and timing of recognized grant have been disclosed, the extent to which the grants are recognized in the financial statement have not been disclosed. This particular part is more on disclosures. So the financial statement shall be enough where the amount for which the grant has been received, it should be disclosed appropriately as per paragraph 23(2) of AS 12. Next, which coming on the promoters contributions, capital investment subsidy, which is in the nature of promoters contributions, has been credited to statement of profit and loss. Now, the following was the policy government grants availed on the nature of capital investment subsidy and other subsidies under the state government incentive schemes are treated as income of the year on sanction of the same and shown separately in the statement of profit and loss. Subsidies in the nature of revenue items are deducted from respective expenditure. The subsidy received during the year under review has been disclosed under other income. Now, paragraph 16 of AS 12, which you need to look at, it says that if it is the nature of promoters' contributions, then it says that should have been credited to capital reserve and to be treated as a part of shareholders fund. So now there is a lot of debate has been done, as we have discussed with Manish ji, that we need to first decide, is it a promoter's contribution or not? If it is a promoter's contributions, then you have to take it as a capital reserve. If it is not a promoter's contribution, it is for specific assets, then you have to take it as a deferred grant or you should reduce from the particular assets. So the discussions may be made more on whether it is a promoter's contribution or not, and then according to the accounting policy which is done. See, accounting policy should be very much clear that it is a promoter's contribution and how it is accounted. If it is promoter's contribution is returned, you can't take it as an income. And if it is capital reserve, if it is a nature of a deferred grant, then you cannot take it as a capital reserve. Now coming to AS 16 borrowing cost. There is accounting policy on valuation of inventory states that finished goods are valued at lower of cost or net realizable value. Cost includes depreciation, interest, excluding interest on discounting of bills, and direct expenditure to the point of stocking, excise duty, but excludes administration and selling expenditure. Now I request your view that what you feel is not correct here as far as this policy is concerned. And Sagarji, you can also respond as your point also correlated with this, your question also correlated with this particular point. Yes, Anurag ji mentioned. See, I think Sanjay ji, we discuss about the point of depreciation. If the depreciation is being on the assets which are being used for the purpose of production of assets, it will be part of my inventory. So depreciation is not the point of question here. As Anurag ji mentioned about the qualifying assets, yes, AS16 borrowing cost, and I see Sagar ji also asked question about interest cost. So yeah, Bothra ji also mentioned if inventories take substantial time to produce, then the borrowing cost. Perfect, Bothra ji. So basically, here AS16 says that any borrowing costs that are incurred for the qualifying assets, then that borrowing costs shall be capitalized. So question is, what is qualifying asset? The asset that takes substantial period of time. Asset that takes substantial period of time to get ready for its intended use is called a qualifying asset. So what will happen that if the interest is being spent on the inventory, and if the inventory is a qualifying asset which takes a substantial period of time, then the interest thereon should be capitalized. So whether interest to be capitalized as per inventory or not, it is based on whether the inventory is qualifying asset or not. And for a qualifying asset, if the inventory takes substantial period of time, which is more than 12 months, then it is a qualifying asset, and then interest on that can be capitalized. So that also give response to Sagar ji's questions. I think Sagar ji asked a question: can the interest cost incurred for purchase of fixed asset to be added to cost? So Sagar ji, if it is basically okay, if it is for qualifying asset, it can capitalize. Sagar ji, if you have some doubt, you can speak, please. You can unmute yourself and you can speak. Sir, Sagar ji, basically, whether it's inventory or whether it's fixed assets, ultimately, AS16 says that if it is for qualifying asset, and qualifying asset means the asset that takes substantial period of time. So, if it is fixed assets, and when the assets I'm doing construction, and for construction of that assets, it is taking a substantial period of time that is more than 12 months in general sense, then it is called qualifying asset. And if that is qualifying asset, interest on that qualifying asset shall be capitalized. I hope Sagar. Oh, great, fine. And now I think there is some discussion is going on about Anurag ji and Bothra ji. Anurag ji has mentioned a point that okay, yeah, how to define substantial period of time. Okay, see, 4 months actually substantial period of time is 12 months, as Bothra ji has mentioned. It should be more than 12 months. If it is more than 12 months, generally like 13, 14, 15 months, then it is a substantial period of time.
What I see here in Surat, people purchasing fixed asset are capitalizing all the interest till the time asset is put to use, whether it is 2 months or 3 months or 4 months. I was just like to point out that fixed asset taking substantial period of time should get interest capitalized, otherwise not.
Yes, Anurag ji, basically that's a good point to make. He's just trying to make a point clear. And it's again, I'm repeated to all of you for the interest of all fraternities in general, that a substantial period of time means more than 12 months. So in case if you're capitalizing for particular fixed assets, where it is 2 months, 3 months, 4 months, 5 months time, it cannot be capitalized. You can capitalize only when the period of time for making it ready for intended use is more than 12 months. Then the interest cost can only be capitalized, not in general case. Bothra ji, yes, up to time and yes, sir. यहाँ पे question Bothra ji, यहाँ पे I would like to point talk about one very important thing, because put to use is not a right word when you're talking about the capitalization, because put to use is in my hand. For example, अगर कोई assets को बनाने में 10 महीना लगता है और मुझे interest capitalize करना है, then I may put to use after 3 months more extra. So I may take more 3 months to put to use. So put to use is not a right word for end of capitalization. It is available for use, readily available for use. That is what which you need to take care. So it is a 10 months, not a 13 months. Because 3 months if you take for put to use, that is something which is in your hand to decide. So that is not the qualifying asset. So we need to look at when is it ready for use. That should be the end point of capitalization, and then you can look at is it a substitute period of time or not. So Anurag ji mentioned point, COVID period interest on suspension should be charged to PL. Okay, so Anurag ji also wanted to put one very good, he's also trying to see that the COVID-19 related issues are also covered here. That is good. So basically what happens that if there are during COVID, there's lockdown. Now during lockdown, the construction that is in progress, project which are in progress, they may be completely held up. Like from 20th March to 19th May, when the complete lockdown, for that particular period, the construction may be completely held up. So that particular is called suspension. So during that period, your loan is going on, your interest is going on, but during that period, the interest is incurred. That won't qualify for capitalization. That has to be charged out to the account. And once the activity resumes, you can again start capitalization of that interest cost. Oh, Manish ji has given a very vital information. Pranab Mukherjee passes away. My God, it has been surprising. Manish ji, any idea he was like having some issues or due to COVID-19, or it was maybe by some other way it happened?
I'm not that I'm not very much aware. His son right now reported, and it came in news, and he was ill. He was in bed.
Achha, he was ill. Okay, maybe health issue. Maybe
Sorry to disturb you all, but then.
No, sir. It's a national news, so I think
Yes, that's
at
right.
least as a professional, we should be aware about that. Okay, Bothra ji has mentioned, yes, sir, not put use. Fine, very good, sir. Okay, let us look at this particular point. So, para 12 of AS2 says that valuation of inventories provides that interest and other borrowing costs are usually considered as not relating to bringing the inventories to the present location condition and are therefore usually not included in the cost of inventories. Para 5 of A16 borrowing costs provide that the inventories that are routinely manufactured or otherwise produced in a large quantities on a repeated basis over a short period of time are not qualifying assets. So, I think what we discussed is the most important thing is that something which is on a large basic quantities on repeated basis, then it is not a qualifying assets because it doesn't take substantial period of time. So that interest cost cannot be capitalized. Let us look at next point. Following are the examples of accounting policies for capitalization of borrowing costs used by different companies. Interest on borrowing for acquisition of qualifying assets capitalized. 1 point. Second, cost comprises of purchase price and other directly attributable cost of bringing the asset to its working condition for its intended use, and include interest on money borrowed for construction or acquisition of fixed assets of the period of asset ready for use. I think this is the point which I would like to point here is that all interest may not be qualifying for capitalizations. We need to look at the requirement. So paragraph 19 of A16 that capitalization of borrowing cost should cease when substantially all the activities necessary to prepare the qualifying asset for intended use or sale is completed. So not 100% interest can be capitalized, only there is some period, start when it shall start, when it shall cease, when it shall end. So based on the conditions when it shall start, when it shall suspend, when it shall resume, when it shall end, based on that conditions, one need to basically capitalize the borrowing cost. So that should be clearly laid down in the accounting policy. So it is a stated account policy would explain indicate point of time to which such cost has been capitalized. In the absence of information, it is not clear. Fine. So accounting policy should be very much clear that what point of time and what cost is capitalized. It cannot be general, left to the readers to understand and interpret. Next next point, some companies are found to be treating debt restructuring charges or external commercial borrowings upfront fees as follows. Restructuring charges which had been paid to extinguish high cost debts were written off over the tenure of fresh loans taken for refinancing such high cost debts. So charges which have been paid to extinguish high cost debts were written off over the tenure of fresh loans taken for refinancing such high cost debt. What is wrong here? Is there anything wrong here? It is about amortizing of these particular borrowing costs over the period of a tenure of new loans. So that is not a correct, because capitalization and amortization. First thing is that there is no concept of deferred revenue as far as AS16 is concerned. It provides you clear guidelines. Okay, when you have to capitalize and rest you do expense off. So when the company has a policy where it says that it is going to, the cost of extinguishment is being amortized over the tenure of fresh loan, that is not allowed as far as AS16 is concerned, and it has to be expensed off. It is not eligible to be capitalized and amortized over the period of the new loans. So let us look at paragraph 4C. It says that it involves a revision in terms of borrowing. Therefore, such costs are not eligible for capitalization with the cost of assets. Further, it was viewed that in case of AS16 does not provide amortization of such costs, as such the treatment followed by the company to defer such expenditure is not in accordance with the account of AS16. So this kind of deferred expenditure is not allowed where the cost is cannot be capitalized as it is not a qualifying assets. Okay, so any questions on AS16 before I further move to AS19, Lizzie? Okay, as there is no response, I believe if there is no question, I will move to the next slide. AS19. Assets has been acquired on finance lease. However, disclosure required in paragraph 22 not been made. See, there is a lot of disclosure for a finance lease and operating lease. Now, when you look at the accounting policy mentioned that the company has taken some asset on finance lease. However, when you look at the disclosure requirement under notes and accounts, there is no disclosure which is required for the purpose of paragraph 22. So, the accounting policy in respect of one company also state that the rent in respect of lease equipment acquired under finance lease is charged to P&L account. So it is observed that the equipment having acquired under finance lease, the disclosure as set out in paragraph 22 have not been made. So under paragraph 22, there is a need to write down the nature, description, amount, carrying amount, MLP, minimum lease payments, then reconciliation of minimum lease payment to carrying amount, then MLP for next up to 1 year, up to 3 years, more than 3 years. So this kind of disclosure is required under AS19. That has to be provided under these particular things. One question which is from Anurag, whether installment payment system is finance lease like car purchase loan. Yes, it is basically finance lease because it is a lease wherein you are going to get and purchase the loan. You are going to buy the loan over the period of time. Once the installment is over, once you make payment, then you get the particular loan. So that is called finance lease. AS19 succeeds AS19 leases. From the annual report of few companies, it has been noted that significant expenses in the nature of rent and higher charges have been shown under administration expenditure or other expenses. The significant amount of rent was there, which was shown in administrative expense or other expenditure. In the annual report of a couple of other companies, lease rentals and rent, including lease rentals, have been shown under operating expenditure. And it is noted from a financial statement that although assets are acquired on non-cancelable lease, however, disclosure of paragraph 25 was not made. So It is more of like, even if it is an operating lease or finance lease under AS 19, there is a clear requirement to disclose certain the specific important aspects of the description, nature, amount, and other things. So paragraph 25 of AS 19, which provides you disclosure requirement, and paragraph 22 of AS 19, which talks about the financial lease disclosure requirement. The finance lease and operating lease, if they both are present as part of your lease rental in your financial statements or finance lease in accounting policy, the disclosure should be there. So that is what I have seen in non-compliance in majority of the companies. In majority of companies, there is no disclosure of the lease which is required in AS 19. So the including notice of account that the company has taken lease under operating lease. However, the disclosure under paragraph 25 is not being made. So please ensure to have all disclosures which are required to be made here. Now with this, we are moving ahead with the last sets of the standards which are on AS 21 to 29. First, AS 22. See, I think this standard, it has been always a cause of concern and has many issues for many practices in CA. Even this standard has been issued for last more than 10 years. But when you look at the non-compliance of this standard is very high. First comes the part of computations. We have seen that in the computation of AS 22, it is not appropriately computed. But however, when I look at these particular issues, the issues which are highlighted here, they are not on computation because measurement cannot be known from the disclosures. So there are two aspects of any compliance. One is measurement, where the how to measure, how to value this deferred tax. So that is not being understood from the only disclosure part. I have seen that in many cases, the measurement of deferred tax asset liability is not correctly done. The understanding of the deferred tax timing difference is not correctly done. So that is what we need to improve. One, as far as the disclosure, where the reporting is done, here also the disclosure is not done appropriately as required under AS 22. So the accounting policy mentions that the deferred tax liability and assets are recognized subject to the consideration of prudence on timing differences using the tax rates substantively enacted on the balance sheet date. So here when you look at it, mentioned the fact that deferred tax liability and assets are recognized subject to consideration of prudence on timing differences using tax rates substantively enacted. Now what is the error here? Can you identify error here? Anyone? Uttara ji, Manish ji, Anurag ji, Sagar. Others are also there, but others are not taking so a lot of interaction, but still, anyone who will do interactions, please. संजय जी तो क्वेश्चन पूछ रहे हैं मुझे. सर संजय जी, मैं आपको क्वेश्चन पूछ रहा हूं, आप मुझे क्वेश्चन पूछ रहे हैं. Good. I will respond to your question also later on. But सर पहले मेरे क्वेश्चन का आंसर दीजिए आप. Instead of reasonable assurance of realization of asset to be ensured, Manish ji says prudence is maybe the issue, right? Exactly, you are on right point, but not exactly correct. Yes, you are. You identify the reason, which is good. Okay, so Manish ji, if I just explain you in detail, yes, you are right that if you talk about the asset, for recognizing different assets, prudence is a concept, but that is not the concept of liability. See, deferred tax, because if you look at here, the sentence says deferred tax liability and asset are recognized subject to consider prudence. So you are also putting the prudence for liability. That is not correct. So prudence cannot be for the liability assets. There is some set of principles which one need to apply for the purpose of this. So let us look at this. It has been noted from paragraph 15 of AS22 that deferred assets should be recognized and carried forward only to the extent that the reasonable certainty that a sufficient future taxable income will be available against which such deferred assets can be. Although the deferred asset has been recognized, however, it is not clear as to whether there exists a reasonable certainty that sufficient future taxable income would be available against which such deferred assets could be realized. Thus, the stated accounting policy with regard to recognition of DTA is not complete. So, prudence is not exactly the right concept. It is for, is it only for DTA or DTL also? It is not clear. And one should write out clearly that the reasonable certainty is the word. Reasonable certainty of the sufficient future taxable income should be written specifically for the purpose of the accounting policy. Then only the disclosure is correct. Now the question which Sanjay B has asked, company which is closed before and balance of deferred is lying, what is treatment? Sanjay B, if the company is closed, means there is no point that deferred tax is going to be an asset is going to be realized or liable to be settled. Then you need to take everything by go for profit and loss account. You need to take whatever DTA, DTL net balance is there, that you need to knock off, and then you need to take to your P&L account. However, in general case, this should not be a big amount, because when you recognize the DTA correctly, then this cannot be a large amount lying on. It can be large amount only when there may be some issues. However, once the company is closed down, in that case, you need to basically take everything to the P&L item. So for debtors not realizable, then deferred tax should be applicable on that amount, specifically for such Corona item. Yes, see what happens that basically, if you look at AS22, AS22 is basically on the concept of timing difference. It is not talking about the temporary difference concept. Now, what happens that if you have created a bad debt, so how to compute deferred tax? For that, you are going to look at the income statement computations. Which are the items of accounting profit or expenditure, accounting income expenditure, which are allowed or disallowed under income tax? So you need to look at the income computations. In the income computation, if something is disallowed and it is going to be allowed in the future, or something is being not taxable today but taxable tomorrow, so these all are called timing difference. On this timing difference, deferred tax asset to be created. Now, if the bad debt has been created, bad debt provision is created, whether the bad debt provision is allowable current year, if it is not allowable and to be allowable in the future, so in that case, whenever the bad debt is recognized, in that case it will create a timing difference, and for the time difference, deferred tax to be created. Why? Because in the future, when you claim deferred on bad debt, that may not be the expenditure in P&L account, because you have already shown as expenditure in P&L account for current year. That will rise as a deferred tax today. Anurag ji, the word realizable value is not a correct word as far as technical interpretation is concerned, because the deferred tax asset, the word is used as reasonable certainty. So reasonable certainty should be there for recognition of deferred tax asset, not a realizable value. Let us look at the next point of AS22. On company closure, yes, I think you are giving response to the answer of Sanjay ji. Fine, that point is already agree. So if it is not a going concern basis, then always of the accounting is different, and in that case, it is written separately. as if it is going to be liquidated. The company has disclosed that deferred tax and current tax not recognized in the absence of book or tax profit or losses. What is the wrong here? Anybody can point out what is wrong here? They have done the disclosure that is not being recognized as there is no book profit or losses. Then what? Is it correct or is it wrong? There is no any financial transaction, timing difference may be there, okay. Anybody wants to? Manish ji, Bothra ji. Fine. So we need to look at paragraph 13. Paragraph 13 says that deferred tax should be recognized for all timing difference subject to the consideration of prudence in respect of deferred assets. So basically it says that you have to recognize deferred tax for all timing difference. Now in this case it says the difference is not recognized, but deferred tax asset may not be recognized. What about deferred tax liability? You cannot take a stand that I don't have profit, so I will not recognize liability also. So liability should be recognized. There is no point of not recognizing the deferred tax liability. So deferred tax should be recognized for all timing differences. Only in case of deferred tax assets, the prudence concept come in pictures, and it will talk about the situation. Otherwise, there is no exemption for recognition of deferred tax liability. Let us look at the next point. Is a company had the carry forward losses and its accounting policy with regard to deferred tax inter alia state that the management is of the opinion that sufficient future taxable income will be available against which such deferred tax asset will be realized. What is wrong here? The company has mentioned that the management is of the opinion that sufficient future taxable income will be available against which such deferred tax asset will be realized. See here, the most important thing is that where there is a history of losses, whether carry forward losses or unabsorbed depreciation, then it is a virtual certainty is required. It is not a reasonable certainty can be done. So in that case, the standard says that paragraph 17 of AS rules requires that where an enterprise has unabsorbed depreciation or carry forward of loss under tax laws, deferred tax assets should be recognized only to the extent that there is a virtual certainty supported by convincing evidence that sufficient future taxable income will be available against which such deferred tax asset can be realized. So wherever there is this kind of statement where unabsorbed depreciation is there, carry forward loss there, then virtual certainty is required. And here it has failed to state that whether there is a virtual certainty is supported by convincing evidence that sufficient future taxable income will be available. Convincing evidence is very important when there is a virtual certainty requirement, not a general case. Next point is that in the balance sheet of a company, both deferred tax assets and deferred tax liabilities have been shown separately on the face of balance sheet. Anurag, yes, show net. Sumit ji कह रहे हैं कि as per AS, DTA on losses can be recognized only if there is virtual certainty with convincing evidence. Sir, perfect है सुमित जी. आप कहाँ पे थे अभी तक? Please, I understand writing will take more time than speaking. So in that case, you can also unmute yourself and speak, sir. We are now next point that yes, Suresh Gandhi ji, yes, only net figure Mukesh Kumar, yes, perfectly, very good. So these I have seen in many cases that DTA is there, DTL is there, is not net off. But however, when the company has only one jurisdiction and it is going to be set off, there's one tax jurisdiction, it should be net off. So paragraph 29 of the institute requires that enterprise should offset deferred assets and deferred liability if the enterprise has legally enforceable right to set off, and the deferred assets and deferred liabilities relate to taxes on income levied by the same governing laws, the same tax jurisdiction for DTA, DTL, then it should be set off. So that is not allowed as far as A standard is concerned. Yes, Sanjay bhai, the last question, in loss case for partnership firm, deferred tax provision applicable as discussed in previous case. Sanjay bhai, what is to be done is that first you need to look at that whether AS is applicable or not. So yes, all AS applicable, fantastic. If all is applicable, in your case, their level 3 enterprise, so then here definitely, because in case of level 3 enterprise also there is exemption in certain standard only. So here also when deferred assets is done, you need to create a deferred liability also. But now what happens that see what happens in generally case, what is happening that in partnership firm, the purpose of preparing your financials are only for tax audit, and if that is prepared for the purpose of tax audit competition, then section 145 method of accounting regularly complied with will come into picture, which requires you to comply with the accounting standards. But the purpose of your reporting of this particular balance sheet is very critical, because I have seen that in case of tax audit where the accounts are to be prepared only submitted only to income tax authorities, then it may not have these things. In my view, then it may be okay. Anurag ji, it will not show true and fair view. As far as tax audit is concerned, we are talking about tax audit reporting for compliance of Form 3CD. So it is not for the purpose of a normal true and full, because under section 44AB, 44AD, our object is to do compliance reporting as per that particular sections, not as per the requirement of some companies at account standards. So even if you look at the 44 AD compliance, it is more of true and correct. And true and correct is kind of the yes, Anurag ji.
Because we are under 3CB, we are giving two reports. One is true and fair view of financial and true and correct view of 3CD clauses.
Exactly, Anurag ji. So Form 3CB
complied with accounting standards applicable to them.
Which accounting standard you to comply? ICDS or you to comply with basically
the accounting standards issued by ICI in case of non-corporate.
And ICDS are also got to be followed for the purpose of your disclosure requirements. So your point is that level 3 enterprise are maybe exempted in my view. Anurag, do you have any issue on level 3 enterprise?
Level 3 means बड़ा वाला company. बड़ा.
नहीं, level 3 is छोटा वाला. Level 3 is not बड़ा वाला. Level 1 is big. Level 2 is small. Level 3 is
almost
small.
All measurement related accounting standards are applicable to every concern. Measurement related and disclosure related accounting standards are given some leverage.
No, sir. I have a different view. I will look at a level 3 enterprise and then I will get back to you on this aspect, because that is not a correct view. We need to look at like level 1, level 2, level 3, and in level 3 there are certain exemptions are provided. And then if that is level 3 enterprise, in my view, again I will definitely discuss and deliberate, and I will WhatsApp to Anurag ji, and Anurag ji can definitely forward to all other participants. In my view, if it is level 3 enterprise and it is only for the purpose of tax audit, deferred tax liability asset, if it is not in balance sheet, should not be issued. But still, I will take this particular my opinion on hold till the time I check it out in my level 3 enterprise and the applicability, and then I will inform to the Anurag ji My humble request to Anurag ji to also forward to the
Under-
all members
under-
once I receive them.
Under Compendium to Accounting Standard, somewhere in 99 or 2000, every measurement related accounting standard was made applicable to every concern.
Anurag ji, I think I understood and it was already told that in my view, your view is different, my view is different. Let us keep this point open, and I will come back to you on this thing. My understanding is such that in case of tax rate only requirement, it is a level 3 enterprise. If the deferred tax is not done, it should not be issued. But still, we'll check it down into the aspect, and then we'll look at, because in level 3 enterprise, AS3 cash flow is not mandatory, and also AS22. There is this to AS18 segment reporting is also not there. So AS18 segment reporting, AS70 segment reporting is not there. AS18 related party, maybe some exemption, and AS22, I think there is some kind of exemption provided in some paragraph. So that we can look at into the aspect. But yes, in general, measurement should be followed irrespective of the any enterprises. But if it is level 3, we will check it out and I will get back to you. Okay, Anurag ji. Anurag ji.
Okay, sir.
Okay. Fine. Let us look at the next point is on, because I think the question which asked by Sanjay ji is very important, because this will affect many cases, because in majority of the cases, basically, in many cases, it is very important that, because when you file for tax rate reporting, a lot of small partnership firms are there, and a lot of small partnership firms, if the deferred tax is done, it is, I understand it's a very complex procedure for all of you. But still, let me look at, I understand it's very critical. As Bhutraji also mentioned that it's very important for all of you. We'll look into that, sir, and then we'll get back to you. I don't want to give any information which is basically not correct, because it will lead to the different purpose. So let us keep this hold, and then we'll basically take this side. Next point on AS22 again. Sanjay ji, you are mentioning something like company there is no deferred tax calculation in other cases income tax. Fine, sir. I think Sanjay bhai, let us keep this point on hold, because I take your point that under for partnership firm it is difficult, but let us look at into this point in detail, and then I will get back to you on this. The deferred tax asset liability had been presented in either of the manner as given below. Deferred tax liability shown as part of the loan fund. And in the next point, there is a deferred tax shown after the head net current assets. Then in one case, deferred tax liability was shown as deduction from application of funds. And in another case, deferred tax liability is shown as part of shareholders fund. In one case, deferred tax liability is shown as distinct subhead under the scheduled provisions. There are different forms where the deferred tax liability was being disclosed. So, what is your view? Is it correct? Sir, separately दिखाया उन्होंने. Separately दिखाया है after head net current asset in one case. In other case, separately shown in application fund. In another case, separately shown in part of shareholders fund. But is the separately shown is okay, or is there any order of relations where it's to be shown? Suresh ji, yes, absolutely wrong, sir. Yes, it's a current asset liability as per nature. Okay, but sir, there under AS22 there is a specific requirement where to disclose, where to show, the where to present is being disclosed here under AS22. Paragraph 30 of AS22 requires that deferred tax liability should be disclosed on the face of balance sheet separately after the head of unsecured loan. So very clearly it's mentioned that after the head of unsecured loan, DTL should be mentioned on the face of balance sheet after unsecured loan, and DTA should be disclosed on the face of balance sheet separately after the head of investment. So they both are being clearly mentioned where to show separately net of DTL, and in one case after unsecured loan In other case, after investor for DTA. That is what is clearly mandated by AS22. Certain companies do not disclose the breakup of DTL or DTA either in the schedule or notes to accounts. So I think that the disclosure is there clearly. Para 31 of AS22 says that accounting for taxes on income requires that the breakup of DTA on DTL into major components of the respective balances should be disclosed in the notes to accounts. Non-disclosure of breakup of deferred tax assets or deferred tax liability is in contravention of AS22. So basically, it is very clear that you need to mention components of DTA DTL in your notes and accounts. Now moving to the next point on para 26 or AS26 of intangible assets. Intangible assets says that from the accounting policy or deferred revenue expenditure given in the annual report of a company, it was noted that expenditure incurred on factory license fees, trademark fees, seed marketing expenses, public capital issue expenses, preliminary expenses, and rental paid for pre-commencement of retail stores, factories has been treated as deferred revenue expenditure, which are being amortized over the life of concerned items. Now, this was the mention under accounting policy. Is it correct? Not correct. Yes, Bothraji. Should be charged to profit and loss account. Sir, all license fee, trademark fee also should be charged to P&L account. Preliminary expenditures to be written off at once, not all. Yes, exactly, Bothraji, not once all. So basically, we need to look at the nature of expenditure. First thing very clear, once AS26 come to pictures, there is no concept of deferred revenue expenditures, and then we need to look at the nature of expenditures, and then we need to take decision whether to be capitalized or to be expense of. So para 6.2, we need to apply, and it says that the expenditure incurred on rental paid for pre-commencement of retail stores, factories, seed marketing expenses, public capital issue expenses, preliminary expenses cannot be considered as to be resource. So for to be treated as asset, it should resource controlled by entity as a result of past events from which a future economic benefit is expected to the entity. How it's not a resource is controlled, so this should be expense of, not to be treated as assets. With regard to factory license fees, trademark fees, it may give rise to intangible assets, but however, we need to look at the intangible assets recognition principles. It should be recognized as per AS26, not as a deferment. It is not a deferred expenditure. And for software development expenditure, product development expenditures, we need to look at conditions for recognition of AS26, which says that development expenditures to be capitalized only when the conditions are specified are complied with. So then, if it is complied with, it is to be capitalized as intangible assets. If it is not complied with, it is to be expense of as revenue expenditure. So there is no concept of deferred revenue expenditure for AS26. Accounting policy of fixed assets given in the annual report of company read as follows. Intangible assets are identified when they are expected to provide future enduring economic benefits. The assets are identified in the year in which the relevant asset is put to use. What is wrong here? Okay, so basically Sanjay Bhai knew it is more of like not put to use. So definition says the word basically it is available for use, not put to use. And in the same kind of word which we use also under borrowing cost. So same way here AS26 we use the word available for use, not put to use for the purpose of this recognition and amortization. Let us look at AS28 impairment of assets. It was noted from the accounting policy on impairment that the impairment loss has been determined on the basis of the net selling price, which in turn has been derived based on expected salvage value. One of the notes says that the impairment loss has been determined on the basis of net selling price in respect of CGU representing specific process plant and other individual assets, the impairment loss had been recognized owing to the prevalent market conditions of the product which was to be manufactured from specific process plants and conditions of individual assets. What is wrong here? Fine. See, basically here basically it says that it is based on net selling price which has been derived based on expected salvage value. See, net selling price is not based on salvage value. There are two methods. It can be value in use or it can be net selling price. But net selling price is salvage value is only when you sell what is available. But net selling price may include some other things. So para 63 says that the salvage value is generally referred to as the estimated value that the asset will realize upon sale at the end of useful value. However, net selling price is what? Based on value can be obtained as the balance sheet date, which cannot be considered to be an end of useful life. So salvage value means what? That, for example, I have an asset, and at the end of 10 years, how much amount I can get is my salvage value. For net selling price, it is the amount which is available today. That is what is as of the reporting date we need to identify for the amount for net selling price, not a salvage value. Valuation method need to be mentioned. Habu, yes, Habu, Mariji, right? S21. Consolidated financial statements of company, the following note was appearing. Most of the accounting policy of the reporting company and that of its subsidiaries are similar and are in line with generally accepted accounting principles in India. However, since certain subsidiaries are in business lines which are distinct from that of the reporting company and function in a different regulatory environment, certain policies in respect of investment, gratuity, depreciation, etc. differ. What is wrong here? Fine. So let us look at this case where it says that certain policies, the word is certain. See, uniform accounting policy is mandatory. However, in case it is uniform accounting is not, then you need to also mention the specific companies and specific accounting policy. What is different? Not etc. is not right word to mention. So para 20 says that proportion of the items in the consolidated financial statements to which this different accounting policy applied, and the fact that it is not practicable. So it is not right given to you that you can write down that I have not done it. You to mention the fact that it was not practicable for you to apply. And if it is done differently, what is the proportion of these items in this consolidated financial where you done differently? That proportion of that item also need to be mentioned. That was not there, so that is basically non-compliance. AS23, note in consolidated financial statements, other income, there was a dividend in income on investment in associates, and there was a non-current investment on investment in associates. Now, what is wrong here? So I understand that it may not be practically be usable by a lot of you. So I am saying in associate AS23 says that you have to use equity method of accounting, and if it is associate is there should be sharing profit loss of associate as a separate line item. There cannot be other income where you mention your income from investments as a dividend income. So that was not perfectly done. So that is the non-compliance here. AS27, interest in joint ventures. For the annual report of company, it was noted that a list of all joint ventures as well as percentage of voting power the same company has been disclosed in CFS. There's no such information available in standard financial. See, please keep in mind that the information requirement of the list of joint ventures and percentage of voting power. That information is to be disclosed in both standalone financial statements and consolidated financial statement. It is not the requirement of only one financial statement. You have to disclose in both standalone and consolidated of this information. That is requirement of paragraph 49 and 52, which says that you have to disclose this in both standalone and consolidated financial statements. Next part, last part, as far as this particular is concerned, AS 29, in the annual report of a company, one of the note in notes to account stated as follows. In accordance with AS 29, the following is considered as contingent liabilities, guarantees given by bankers for performance of contracts and others. So, here, what is wrong here? See, guarantee is given by contractual liability to be given contractual liability. So, amount should be mentioned, fine. See, there are two guarantees. One is a financial guarantee, second is performance guarantee. So, basically, performance guarantee is not required to mention here. So, it is noted that a guarantee given by bankers for performance of contract have been disclosed contingent liability. However, guarantees given against own performance of company do not give rise to contingent liability, because the company in any case holds an obligation to perform the event against which guarantee is given, which is also supported by paragraph 8.8.72 guidance note. So, guarantees can be a performance guarantee, it can be a financial guarantee, both can arise from contract. However, we need to only look at the financial guarantee, and any financial guarantee that need to be disclosed here, not a performance guarantee. Next point, long-term provision, short-term provision. There was a provision for expenditure in the long-term and short-term both. What is wrong here?
So this point is very crucial, because in layman language we treat all a certain liability as provisions.
You are saying earlier point or this point? This point?
In this provisions, in
okay, provision point.
In layman practice, we consider all a certain liability, say salary payable and other, as a provision.
Right.
That's why we classify as provisions.
Right, Anurag. I think that you have rightly pointed out. This is something. What happens that we use the word provision and liability. Actually, liability and provision word, they both word are used simultaneously, or sometimes it is used like both are same thing, but both are not same. Provision is on the estimation, and so basically we need to be very sure about that. The provision, when you say expenditure, it is accrued. When you say expenditure is accrued, it is liability. It is a provision, because you accrued, something is already happened. So that is a liability, not a provision. So provisions are made for those liabilities, the measurement of which involves substantial degree of estimation. See, when any expenditure is accrued, there is no substantial, there is estimation, but it was substantial degree of estimation. So if there is no substantial degree of estimation, then it is not a provision, it is treated as a part of liability. So please keep in mind, as Anurag ji has mentioned, that if you are looking at this expenditure part, then please ensure it is not a provision, it is liability. It should disclose a part of basically your liability, not as provisions. Next point is on basically the company has not provided for mopping of subsidy on raw materials of fertilizer in terms of office memorandum issued by Ministry of Chemical Fertilizer Government of India, which is being reconsidered and decided not to effect recovery till a policy in this regard is formulated. These are strengthen the management's view for not providing the same. What is wrong here? Okay, see, basically here whatever the company says that I have not provided. I have provided 2 years back, and now my view of not providing is strong. Why? Because the some memorandum is issued. See, basically you have to do estimation. See, is it a provision of contingent liability? That it has to be very clear. So the information recovered paragraph 68 is not disclosed because it is not practicable to do so. The fact should be stated. So where while disclosing details of contingent liability, an estimate of its financial effect should be given unless it is not practicable to do so. Now, when the management says that I have not provided, so fine, it is contingent, fine. But what is the quantum? As a reader of financial statements, one need to understand the quantum, because sometimes what happens that the amount of contingent liability can be very big, which can wholly affect the financial statements. So unless until you mention the fact, I think in earlier case of Sanjay ji talking about the amount to be mentioned. Yes, same way here, so amount to be mentioned. If this amount is not mentioned in contingent liability, it may not give the right impression as far as this is concerned. Now, this is what basically we should discuss about all the standards. I recommend each one of you to please look at into the compendium of all commonly found errors by FRRB, which is available on ICI website, and where they mention standard-wise compendium of commonly found errors. And the attempt has been made during these presentations to provide you with a many standards, lot many issues, and my humble request to each one of you to please apply it. Learning is one part which has been done today, and the goal is achieved of me and the and this textile CP circle only when you apply in practice. And please take care in your financial statement that non-compliance of account standards are being appropriately adhered. And in my view, if you really want to basically ensure non-compliance, then the first is the training yourself, learning yourself, and second is the learning and training of the staff.